All right, let's dive into something that, let's be honest, might not be the most exciting topic at first glance, but is undeniably important: long-term care.
Yeah, definitely not the most glamorous subject, but definitely crucial.
You guys send in some really interesting excerpts from a tax guide all about deducting long-term care insurance, and get this, specifically for business owner.
Oh, this should be good. I love a good tax strategy.
Right. And the best part, this stuff can actually lead to some significant savings, which is always a win in my book.
Absolutely. Every little bit counts, especially when it comes to taxes.
So this tax guide jumps right into the thick of it. But before we get lost in the details, let's take a step back and talk about why we even need to care about this whole long-term care thing. I mean, we've all heard of Medicare, right? The big kahuna of healthcare and retirement.
Right. Everyone's supposed safety net.
Exactly. Except when it comes to long-term care, Medicare might not be the knight in shining armor we expect it to be.
It's true. Medicare has its limitations, especially when you're talking about extended care. We're talking needing help at home or in a facility long term. In those cases, Medicare only covers a tiny fraction of the costs.
Yeah, and our guide actually breaks down the numbers here, and it's a little eye-opening.
Yeah, you're only looking at a maximum of 100 days of coverage for skilled services, and
Yeah.
even then, it's not exactly free.
And that's when a lot of people think, okay, no worries, Medicaid will swoop in and save the day. But as our handy-dandy guide points out, Medicaid has some pretty strict requirements when it comes to your finances.
Yeah, it's not as simple as just qualifying for assistance. You have to essentially have very limited assets to qualify for Medicaid, which isn't exactly the retirement goal for most folks.
It's like the opposite of what we're all working towards.
Exactly. And that's where long-term care insurance comes in to fill that gap. Think of it as a financial safety net, so you're not draining your savings or relying solely on government programs that have pretty stringent rules.
It's about having options and peace of mind, really.
Absolutely. And that's something everyone deserves, regardless of their age or financial situation.
Couldn't agree more. So we've established the why long-term care is expensive and having insurance is crucial. But the big question is, how can we make this work financially, especially as business owners?
And the million-dollar question.
Our guide actually lays out 3 potential paths to deducting the cost of this insurance: snagging that coveted 100% deduction, navigating those tricky tax code limits to maximize what you can deduct, or rolling the dice with itemized deductions. Let's start with the dream scenario: deducting the entire cost.
Okay, now you're speaking my language. Everyone loves a good 100% deduction.
Right. And this is where things get super interesting for anyone running a C corporation.
Ah, the wonderful world of C-Corp. They do have some unique advantages.
They do. A C Corp can actually offer long-term care insurance as a tax-free benefit to its employees.
Wait, really? So it's like offering health insurance, but for long-term care?
You got it. And here's the kicker: the corporation can then deduct that same expense on its corporate tax return.
Whoa, so it's a win-win. The employee gets a tax-free benefit, and the corporation gets a deduction.
You're catching on. And it gets even better. The guide points out that corporations aren't required to offer this benefit to every single employee. So even if you're a company of one, you can still use this strategy.
Okay, now that's interesting. So even solopreneurs can get in on this action.
You bet. There's even a strategy involving what they call a spousal employee.
A spousal employee. Now that sounds intriguing.
It's all above board, of course, but it essentially allows sole proprietorships and single-member LLCs to get in on the action too.
Right, because technically they wouldn't have employees in the traditional sense.
Exactly. And the key here is utilizing something called a Section 105 HRA.
A 105 what now?
I know, another acronym. It stands for Health Reimbursement Arrangement. Essentially, by structuring things so that your spouse is an employee, you can use this HRA to cover your long-term care insurance premiums. It's like a clever workaround.
Okay, so it's all about being strategic with how you set things up. I
Oh.
like it. Tell me more about this 105 HRA thing. How does it actually work in practice? So basically picture this. You've got this bucket of money, right?
Okay, I'm visualizing a bucket.
That's the 105 HRA. Your business sets it aside specifically for healthcare expenses. And since you're technically covering your spouse as an employee, the premiums for your long-term care insurance, boom, they can be paid right out of that bucket. And the best part, those reimbursements are tax-free for your spouse.
So not only does the business get a deduction, but the spouse also gets a tax credit on the reimbursements.
Exactly. It's like a double whammy of tax savings.
I'm starting to see why they call this an arrangement. It's like a perfectly orchestrated tax waltz. But our guide does mention that this 100% deduction utopia isn't always achievable. There are some rules and limitations.
Yeah, unfortunately, the tax code loves to throw in a few curveballs.
Yeah.
It's like they want to keep us on our toes.
Speaking of curveballs, our guide talks about these age-based deduction limits.
Ah, yes, those pesky age limits. While long-term care costs can pop up at any age, the tax code seems to think that if you're younger, you're invincible or something.
Right, like you don't need to worry about that until you're older. So for anyone thinking, wait, there's a limit to how much I can actually deduct, you're not alone. The struggle is real. Let's break down these age brackets for 2024 because, as our guide helpfully lays out, the numbers can get pretty specific.
Okay, let's get into the nitty-gritty.
Hit me with the numbers.
Right, so if you're 40 years old or younger, the maximum you can deduct is $470. Then, if you're between 41 and 50, it bumps up a bit to $880.
Okay, so not exactly chump change, but still.
And then things start to get a bit more interesting. Between 51 and 60, that limit jumps to $4,760.
A more noticeable difference.
Right, but don't get too excited, because then things get even more real for the 61 to 70 crowd.
How real are we talking?
For that age group, the maximum deduction skyrockets all the way up to $4,710. And finally, for those 71 and over, you're looking at a max deduction of $5,880.
Okay, so it's like the tax code is saying the closer you are to actually needing long-term care, the more we'll let you deduct. It's like they finally believe you need it.
Right, it's like a reward for getting older.
Okay, but in all seriousness, this brings up an important point. How do these age-based limits actually work for different business structures? Because we've got sole proprietors, single-member LLCs, S-corp owners, partners, it's a whole mix. And the guide mentions something called Form 7206. Is that going to be the bane of our existence?
Well, I wouldn't say the bane of our existence, but Form 7206, yeah, it's definitely going to become your new best friend if you're trying to deduct those long-term care insurance premiums.
So it's important no matter what your business structure is.
It's the key to unlocking these deductions. It's like the VIP pass to claiming what you're owed. But let's not forget about our trusty 105 HRA plan that we talked about earlier.
Ah, yes, the spousal employee magic trick.
Exactly. That strategy can be a real lifesaver for those sole proprietors and single-member LLCs out there because it allows them to potentially sidestep those age-based limits altogether.
Yeah.
It's all about shifting that deduction to the business.
It's like finding a secret shortcut in the tax code maze. I love it. Okay, so we've got our 100% deduction dream, navigated the reality of these age-based limits, and even uncovered a potential loophole or two. But what about those who don't quite fit into those scenarios?
About them.
Well, our guide does mention a third option. It's not quite as glamorous and is even labeled as a bit of a crapshoot itemized deductions. What's the deal with those?
Yeah, let's just say itemized deductions are not the ideal route.
Our guide actually calls it the bad, sad place for medical expense deductions.
Well, they're not wrong. It all comes down to that dreaded 7.5% AGI threshold. Basically, you can only deduct medical expenses, and yes, that includes those pesky long-term care insurance premiums that exceed 7.5% of your adjusted gross income.
Okay, so there's a threshold we have to cross even before we can deduct anything.
You got it. And to add insult to injury, you can only claim those deductions if you itemize. It's like jumping through hoops made of tax forms.
So it's not exactly the easiest or most straightforward path?
Not at all. Our guide actually gives a pretty helpful example to illustrate this point. Imagine this. You're 52 years old, and your AGI is $100,000. You're paying, let's say, $4,000 for long-term care insurance and have another $8,571 in other medical expenses.
So you're sitting on a hefty $12,571 in total medical expenses. That's a lot of money.
It is. But hold your horses before you start celebrating potential deductions because we have to remember those age-based limits we talked about.
Oh, right, those pesky limits. So where do they leave us in this scenario?
In this case, you can only deduct $1,760 for your long-term care insurance.
That's a significant difference already.
Right. And then we have to factor in that 7.5% AGI hurdle, which means you're only left with a measly $2,851 that you can actually deduct.
Wait, seriously? From $12,571 to just $2,851. That's quite a difference.
That's the bad, sad place for you. And it highlights why it's so important to explore every other avenue for deducting these premiums before you even think about going down the itemized deduction route.
So if you've got the option to utilize a Section 105 plan, like we talked about before, whether it's that spousal employee strategy or within a C corporation, that's definitely the way to go.
Absolutely. Go for the sure thing. Don't mess around with itemized deductions if you can avoid them. It's all about being strategic and knowing your options, which is why having a good tax professional on your side is never a bad idea.
It's like having a guide in the tax jungle.
Speaking of guides, before we get too lost in the weeds of deductions and forms, I want to circle back to something our trusty tax guide emphasizes over and over again, and that's the importance of making sure your insurance is considered qualified.
Qualified, you say. Not just any old insurance will do. It's not just bureaucratic jargon. That qualified label is crucial if you want to unlock those sweet, sweet tax benefits. Your long-term care insurance policy needs to meet a very specific definition of qualified in the eyes of the IRS.
So it's not enough to just have any long-term care insurance. It has to be the right kind of long-term care insurance. Got it. What does qualified actually mean in this context?
I'm glad you asked. Our guide lays out 4 key criteria. First and foremost, your coverage has to be strictly for qualified long-term care services.
So none of those fancy add-ons or anything like that. It's got to be the real deal.
It's got to be the real deal. And secondly, the policy needs to be guaranteed renewable.
Guaranteed renewable. So that means the insurance company can't just decide to cancel your policy out of the blue one day.
Exactly. They can't just leave you high and dry. Security is kind of the whole point, right?
Absolutely, especially when you're talking about something as important as long-term care.
No, we've covered 2 criteria, guaranteed renewable, and knowing the coverage needs to be specifically for qualified long-term care services. What else do we need to make sure our policy has that coveted, qualified stamp of approval? So we've got guaranteed renewable, and the coverage needs to be the real deal, those qualified long-term care services. What are the last 2 hurdles to clear that qualified hurdle?
Right. So the third thing is the policy can't have what's called a cash surrender value.
Meaning
you can't just decide to cash it out later on like you might with some life insurance policies. It's not a piggy bank.
Got it. It's got to be for its intended purpose.
Exactly. And then, last but not least, it can't reimburse you for any expenses that are already covered by, drumroll please, Medicare.
Medicare, there it is.
Of course.
So it's like the IRS is saying, we'll give you this tax break, but only if you're really, truly using this insurance for its intended purpose to cover those long-term care costs that other things don't. Makes sense to me. Now, our guide also dives into something that I think a lot of business owners out there are probably curious about. We've talked about deducting your own long-term care insurance, but what about when you have employees?
Ah, yes, bringing the team into the mix.
Exactly. It specifically mentions partnerships and S corporations with, let's say, less than 50 full-time employees.
Right, because those businesses, they're actually exempt from the Affordable Care Act, which means they're not legally required to offer health insurance to their employees.
Which, on the surface, might sound like a good thing, right? Less paperwork, less hassle. But, as our insightful guide points out, even if it's not mandatory, many businesses still see the value in offering some kind of health benefits. It's good for attracting and keeping those awesome employees. So what are the options in that kind of in-between zone?
Well, there are a couple of key players that come to mind. ICHRA and QCHRA.
Okay, more acronyms. Help me out here.
Sorry. It's acronym overload, I know. ICHR stands for Individual Coverage Health Reimbursement Arrangement, and QECHRA is the Qualified Small Employer Health Reimbursement Arrangement.
Okay, so both of these are.
Essentially, they offer a more flexible way for businesses to reimburse employees for their health insurance premiums.
Got it, including long-term care insurance.
Including long-term care insurance, you got it. And they do this without all the headache and often the cost of traditional group health plans.
So more flexibility for the business and potentially some tax benefits sprinkled in.
Sounds like a recipe for success.
Right. A true win-win. Well, we have certainly covered a ton of ground in this deep dive.
We've been deep diving deep.
We really have. From the why, those potentially back-breaking costs associated with long-term care and the limitations of programs like Medicare and Medicaid.
Yeah, those got real quick.
To the how, all those different tax advantages available to business owners like yourselves out there. We talked about the holy grail, that 100% deduction for C corporations, and even uncovered some of the less obvious strategies like utilizing those HRAs, even for the little guys.
Yeah.
And of course, we can't forget the importance of making sure that your policy ticks all those boxes to be considered qualified in the eyes of the IRS.
I love the IRS.
I love them. But hey, you know what? At the end of the day, I think the biggest takeaway here, the thing I really want everyone listening to walk away with, is the power of being informed.
Absolutely. Knowledge is power, especially when it comes to the taxes.
Right. And by understanding these benefits, these tax advantages that are out there, you are empowered to make smarter, more informed decisions about your own long-term care planning. And those decisions, those can have a ripple effect on your financial well-being for years to come.
No doubt about it. And don't be afraid to bring in reinforcements. Yeah,
Reinforcement.
tax professional, they can help you figure out the best strategy for your unique situation. They're like the Sherpas of the tax world. They
Yeah.
guide you through that treacherous terrain.
Yeah. I love that analogy. Okay, so as we wrap things up here, I want to leave you with one final thought to chew on. We've talked a lot about the financial side of planning for long-term care, but here's something else to consider. By taking advantage of these tax benefits, could you potentially free up some resources? Resources that you could then invest in other areas of your life, your business, your passions, whatever lights your fire. Just something to think about. This has been a fascinating deep dive. Thanks for coming along for the ride. And remember, planning for your future, it doesn't have to be scary or overwhelming, especially when you've got the tax code on your side. Until next time.